This video will teach beginners about the Forex market, specifically what it is, how it moves, and who trades it. I intend to put together a complete series of trading videos leading you from foundations right through to trading mastery. I spent a lot of time and suffered a lot of stress and heartache, not to mention financial loss, on my journey learning how to trade. And so the series that I put together will be exactly what I wish had been available for me. So, what exactly is Forex? Well, Forex simply stands for foreign exchange. What you're looking at when you look at any Forex chart is essentially the strength of one currency in relation to another currency. Let's look at two popular currency pairs as an example. We have US dollar, Japanese yen, which is abbreviated to USD, JPY, and also the Great British Pound, Euro, abbreviated to GBP, EUR. This is how you will see Forex pairs displayed, shortened down to three-letter abbreviations. The currency on the left of any pair is always the base currency. Forex trading is simply speculating whether the base currency of any pair will rise or fall. If you thought the base currency was going to rise, then you would go long. If you thought it was going to fall, you would go short. If we look at the Great British Pound Euro, we already know that the currency on the left is the base currency, so that means the GBP. The currency on the right is known as the counter currency. In this pair, that's the euro. You are speculating on the base currency in relation to the counter currency. So you would go long if you thought the GBP was going to strengthen compared to the euro, and short if you thought it was going to weaken against the euro. Let's say that the current exchange rate of the pair is 1.1207. Most currency pairs are displayed to 4 decimal points. What this exchange rate means is that one of the base currency, so here it would be 1 Great British Pound, is worth €1.12. When Forex pairs move, they do so in terms of pips. A pip is simply a percentage point. A change in the 4th decimal point of the currency pair by 1 would be known as a 1 pip change. Let's look at that in a little more detail. If we reintroduce the exchange rate of 1.1207 and say that the market pushes higher to 1.1209, then there has been a 2 pip increase. If we say that the exchange rate fell from 1.1207 to 1.1200, then there has been a 7 pip fall or decrease. This can be explained in even simpler terms if we swap it into a situation we can all understand. Let's imagine a family from the United Kingdom is going on holiday to somewhere in Europe. Just before they leave, the exchange rate strengthens to 1,4000. This means that when they change their money into euros, they would receive €1.40 for every pound sterling that they changed. If, however, before they left the exchange rate fell instead of rising, and it dropped all the way down to 9,800, then they would only receive 98 cents for every pound sterling they converted. So, Forex markets are displaying the strength of any particular currency in relation to the counter currency, and it is as simple as that. This is a Forex chart of the Great British Pound Euro. I've set it to the daily time frame, so every candlestick you can see on this chart represents one full day of price action. Here we can see where the year 2015 began. If we look at the exchange rate at the beginning of 2015, it was approximately 12,900. That means that £1 would get you €1.29. Later in the year, on the 28th of April when this screenshot was taken, we can see that the exchange rate has risen to 13,963. So, on the 28th of April, £1 would buy you €1.39, or €1.40 if we round it up. That's a 1,063 pip increase over the 4 months of 2015. That would have been a very nice trade if you had been long. In fact, if you had bet £10 per pip, your return would have been £10,630. Now that we understand a little about what Forex is, you may be wondering who it is that actually trades Forex. Forex is the most traded financial market in the world. In any one day, over $4 trillion is traded. Forex is traded by banks, institutions, and also individuals. So it's a pretty diverse market. And what actually moves the currency pairs of the Forex market? The truth is, currencies are influenced by lots of things. It can be anything from international trade, monetary policy, political and economic stability, news events, or a myriad of other factors. But what you must realize as a trader is that all markets, not merely Forex, move primarily because of human emotion and psychology. It is the beliefs of traders and the reactions to those beliefs that move the market. I have come to understand that psychology is the most important aspect of trading. You need to be able to understand how other people think and react in any given situation. But much more important than that, you must be able to understand yourself and control your own emotions. That is the absolute key to successful trading, and I intend to teach you a lot more about how to do it in future videos. But for now, that is the basics of understanding Forex. I hope you enjoyed the video. If you did, please subscribe to Decisive Trading and also like the video. As I have already mentioned, I intend to put together a full series of videos, exactly what I wish had been available to me when I started, leading you from absolute beginner through to trading mastery. I'm James Orr, and thanks for watching.